In today's podcast, I'm going to chat with Dr. Andrew Wilson, Australia's leading housing economist, about his reflections for the year 2024 and his forecasts for 2025. Welcome to another episode of the Michael Yardney podcast, where twice a week we help property investors gain clarity in the chaos of the many mixed messages so that they can develop the financial freedom they deserve. Now, this is the first of a series of end-of-year podcasts that I'm recording with a number of experts, looking back over the year, seeing what trends surprised them, and seeing what thoughts they've got for the year ahead. Why not learn from these experienced investors? And obviously, I give you my thoughts as well. So if you're keen to find out what's ahead, let's listen to the chat with Dr. Andrew Wilson. Let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
It's customary at the end of the year to look back at the year and see how things went, and then look forward to make some predictions for our housing markets for the year ahead. And who better to do this than Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market. Hi, Andrew.
Yeah, good day, Michael. And here we are again, looking forward.
Wow, the year went quickly, didn't it?
Yeah, we say that every year, don't we?
Yes, we do, and they say it goes quicker when you're older, but that's not the case with us, is it?
No,
I remember every week we have a Property Insider video chat, and at the beginning of the year there are a whole lot of forecasts. Some predicted interest rates would fall during the year, others predicted interest rates would rise considerably over the year and thought that would cause a housing market crash, yet others predicted Australia would fall into recession. But each week in our regular Property Insider chats, you shared your thoughts, and they are on the record. And clearly you didn't make any of those wild claims, and your forecast for the total returns over the year for our property markets were pretty much spot on. So I'd like to ask you, were there some major trends that you observed during 2024?
Well, 2024, Michael, I think we could call it a consolidating year in a sense. Of course, if we look to the context of the last couple of years, and it is a cycle, and of course, the cycle is influenced by, significant changes to economic factors, and that means typically changes to interest rates. And we've seen that work its way through the system over the last couple of years. Of course, we had COVID, we recovered from COVID, that created inflation, which meant higher interest rates. Higher interest rates impacted affordability and sentiment. When we opened our borders up again, of course, we had a surge in migration. So these sort of factors work their way into ups and downs in the housing market. And of course, we saw the recovery last year following those interest rate rises in 2022. In 2022, we lost around about 10% in terms of overall prices. Last year, we regained all that we lost. And this year, we've built on that and consolidated. And we're going to have around about, when all the final data is in, a very similar result to 2023 in 2024. So it's been a consolidating market. But I think that in terms of overall numbers, but what we did see was, the breakout in the big three, if I can call them that, and that's Brisbane, Perth and Adelaide, which continued to grow strongly and make significant contributions to that higher national house price. Sydney was, okay, solid, steady Sydney. Its increases similar again to 2023. But we are seeing, the typical easing of the cycle in Sydney as, buyers have been satisfied and price barriers are now starting to impact price growth. But the market's still quite active in terms of buyer and seller numbers. It's just that once we get to the peak of the affordability cycle, buyers just can't keep going to the banks and asking for more money because the banks have rigid lending conditions. And if you're not earning more or interest rates aren't lower, well, you can't borrow more. And that's what's sort of happening in Sydney. But Melbourne's been another underperformance from Melbourne compared to the other major capitals. So that's basically it, a mixed bag from the capitals. Strength in Adelaide, Brisbane, Perth. Consolidation, solid results from Sydney, although affordability is starting to ease prices growth, affordability constraints, and Melbourne's still looking to revive along the lines of the other capitals.
Now, 2020-21, the property boom, which I called a once-in-a-generation property boom, created by those very low interest rates, was very unusual. Every property sold, every property went up in value, whether it was on the main road, on a terrible corner, good properties, A-class properties and C-grade properties. But that was unusual, and fragmented markets, different markets being at different stages of the cycles is normal, which is what's happening at the moment. But I haven't seen a differential between Melbourne and Sydney as much as this since well into the early 90s, Andrew.
Yeah, that's right, Michael. And of course, that sort of screams opportunity. I think Melbourne's at one level still recovering in terms of confidence from what was a very severe lockdown period. We know that. We don't have to go into that again. But I think confidence is still rather bruised from that period. And also, there have been some policies from the state government. The Melbourne economy has underperformed, and some of those policies have been directed at property owners. And I think other than the real impact in terms of the amount that property owners, particularly investors, have had to pay for increased land tax, it's also added to that, sort of fragile confidence going forward. But I think that, Melbourne is a market that's looking, as you said, to recover its position in relation to the other capital city markets, particularly Sydney. And I think a lower interest rate, whenever that comes, will be the key. And I think the other thing that's influenced the Melbourne market, particularly recently, has been changes to the immigration policy, which has restricted student numbers coming in. Which has come from the federal government, and Melbourne's very, very strong in terms of international student numbers, and I think that's also had an impact on some parts of the property market. But I do think overall it's a confidence issue. Melbourne has been underperformed in relation particularly to what's happening in prestige markets in Melbourne. The inner south, the inner east and the inner city have all been subdued. Budget and mid-price markets have continued to perform reasonably well. So I think that, the big picture is that, Melbourne is dragging the chain, but I do think that offers some opportunities going forward because overall the Melbourne market is still strong in terms of its economic drivers. It will attract more migrants than any of the other capital city markets as usual, eventually, and that will act to boost the market. And of course, it has affordability advantages, Michael, which is pushing up yields clearly now. And I think some investors are starting to realise that and take advantage of it.
It reminds me very much of the early 90s. I know you were involved in the Melbourne property market in those days, as was I. And there used to be a joke going around saying the last person to leave Victoria, please turn the lights off. And then eventually the market moved on. We actually got a new state government. Jeff Kennett came in, confidence recurred, and the Melbourne market did what it always does. It recovered and became one of the strongest property markets over the last 20, 30 years.
Yeah, and I think the big difference is that Melbourne went through a almost catastrophic economic condition there in the early 90s. It was terrible. We haven't had the same, disparity in economic performance in Melbourne generally. I'm talking about the unemployment rate, retail sales, these types of real economic factors that we had back in the early 90s. So haven't got that much to recover as we did back in.
No, they were terrible days then. Okay, just looking back at the year 2024, I know you've been around the block quite a few times and you do a lot of research, but were there any surprises that caught even you off guard this year?
Well, I think the strength of those three capital city markets continuing, that's Adelaide, Brisbane and Perth. Perth is really showing no signs of slowing down, still very much on the upside, and it's been consistently rising over 2024, Michael. Of course, we've got to understand the Perth market went nowhere for the best part of a decade, following the end of the that mining boom back in 2012, and the end of the fly-in, fly-outs, and the market was quite subdued for some time. I'm not sure it's going to regain its position in terms of its relative prices, but it's certainly continuing to improve. And so I guess it's sort of bouncing back, and it's got some way to go before it does get back to where it was a decade ago. But nonetheless, I think that you can't really sort of predict that markets will catch up to where they've been before. But Perth is sort of doing that at the moment, and that was a surprise to me. Brisbane continuing to grow. It had a drive from very strong interstate migration through the COVID lockdown period that certainly drove higher rents and prices. And that's continued even with that surge in international and interstate migration easing. But, the Brisbane market continues to keep on keeping on, although some very early signs that it might be starting to peak. At least its price growth rates are starting to peak, which is not surprising given how strong they were for both rents and prices. And Adelaide, similarly, it's continued to be quite strong in terms of its growth. It's also showing some signs of those affordability barriers starting to impact price growth. But that was a surprise to me, just not the growth. I thought they'd be the strongest, but the level of growth is certainly surprised. And the other one, I guess, which we were just talking about, Michael, is Melbourne really spluttering along, showing some early signs and then sort of moving sideways, just sort of trying to recover, but not succeeding at this point. So they were the surprises for me.
Clearly, auction clearance rates in Melbourne are holding up reasonably well. People are buying properties, but there seems to be a little bit more supply in Melbourne. Melbourne's actually done pretty well in building new dwellings compared to other states.
Well, that's what we see from Melbourne. Typically, it's Melbourne provides 60%, around about 60% of all new dwellings approved for building, and that's continued this year. I think the offset to that is that. And the state government's making some moves to improve the planning restrictions, but there's still some problems in terms of their taxation, particularly of the investor market. So whether that's impacting real outcomes or confidence is moot, but I think that's part of the story. But yes, it does have a much better supply to demand ratio in Melbourne, and over the longer term that will be a positive. And they are making, Melbourne are making, or the state government is making some positive moves in terms of improving planning access particularly in some of those leafy inner suburbs now, which is where everybody wants to live, but there are obviously restrictions there for higher density, which the state government is trying to address.
Well, it's interesting the state government's got these policies. Will it actually work? They don't build any property, so we've got to make them financially viable. It'll be interesting to see if developers can do that. When I asked you about the surprises for this year, it didn't surprise me that you didn't mention interest rates. And I think if I would ask other people the question, they'd say, I'm surprised that property values kept rising despite interest rates. But I remember right at the beginning of the rate rising cycle, you saw that there wasn't a direct relationship between higher rates and falling prices.
Well, the affordability sort of measure was what was working for the market. As I said, we lost about 10% in 2022. We gained around about that what we lost in 2023, and this year we've consolidated that with more gains around about what we had last year. So really the net gain is this year, or 2024 has been the net gain. And of course we've got a strong economy, low unemployment, wages are rising at record levels, and our interest rates are still below, official rates anyway, are still below where they were in 2012, Michael. So, we certainly had the capacity, the affordability capacity to push prices up, and that's what's happened this year. And I think that as oil, we've got to remember that oil started to bounce upwards 3 or 4 months ago. I think many have forgotten that, and it was the prospect of that the Reserve Bank changed its stance to say that it wasn't ruling anything in and out in terms of the potential for perhaps interest rate increases. But the price of oil has certainly reversed significantly since then, and that has provided the relief in headline inflation. And the outlook for the price of oil now is certainly looking more positive, which is good for inflation. But as I said, I think that the prospect of higher rates were quite clearly there a couple of months ago, with oil prices starting to push up to $90 US a barrel. But now, they're pushing under $70 US a barrel, and may get even lower, but still too high. But it's certainly been a positive for inflation and a positive for interest rates. But our interest rates, Michael, let's remember that the US have cut their interest rates by 0.75% over the last 2 months, and they're still around about where we are in terms of our interest rates. Our interest rates have been well below the US rate, so just because they're cutting it doesn't mean that if we're looking to compare one with the other, that we've got that same potential to cut rates as the US have, because our rates are around about the same. But our inflation rate is well above the US rate. So I think, as I said, the outlook for inflation is still mixed, but better. But I certainly think the outlook for interest rates is steady as she goes.
We'll talk about interest rates in a moment, because I'd like to ask your predictions for 2025. But one of the other trends that I've noticed over 2024 is investors leaving the market, selling up their properties. Some got into problems because interest rates went up. Others are just sick of the government interfering. But another interesting trend when you're looking at home loan approvals is how many more are now in loans for investors, and how investor lending has increased considerably over the last 12 months.
Well, it's been a boom in investor lending, and we shouldn't be surprised at that. And of course, it's the major the states where we're seeing strong prices growth in the capitals, and that's South Australia, Western Australia, and Queensland, have had remarkable growth in investor lending this year compared to, or 2024 compared to 2023. Now, there was a rebound coming because investor lending was an underperformer, but it's certainly recovered what it lost and more. And we shouldn't be surprised. Strong capital growth, higher rents, yields holding has to attract investors, and particularly reflecting the underperformance of other asset classes, particularly the stock market, by comparison, Michael. And investors have certainly marched into housing markets, particularly Perth, Adelaide and Brisbane, and that shouldn't be a surprise given the returns that are available there.
Well, let's look forward to 2025 now, Andrew. And I guess interest rates are always going to be in the news. What are your thoughts about when the Reserve Bank is going to first start cutting interest rates?
I don't think it's till at the very, very earliest late in 2025. The Reserve Bank has clearly said that it needs a sustained period of inflation, underlying inflation at 2.5%. It is at 3.5% to the September quarter 2023. That means it would have to fall from the current 3.5% to 2.5%, which is a very sharp decline in underlying inflation, which takes out the volatile elements such as fuel, for that to occur. And the Reserve Bank is logically saying that, in their opinion, won't occur till 2026. So just following, the Reserve Bank's model, we're not going to see lower rates until then, only if we can get inflation down, to the midpoint of the target range, 2.5%, for a sustained period. And, as maybe the prospects of higher inflation through the new US government, perhaps, who knows, that will only mean that will sort of go longer, be longer. So I wouldn't be looking at lower interest rates on that premise, on what the Reserve Bank's telling us, and they set the rates until the end of 2025. And as I said, I think that the only way they're going to come down that sharply that quickly is if we have an economic shakeout, which there's just absolutely no sign of going forward.
Well, we know that all four big banks have predicted the first interest rate fall to happen in February. We also know their track record for predicting interest rates isn't the best. It's interesting how different their thoughts are from the Reserve Bank. But if I get it correctly, the next quarterly CPI figures, which are the ones the Reserve Bank are going to be placing more emphasis on, are going to happen just before the February Reserve Bank meeting. And it's, as you say, it's unlikely there's going to be a significant fall, and it definitely won't be a consistent fall because it'll, if there is one at all, because it'll be the first fall. So from what I'm hearing you say, don't even consider an interest rate cut in the first quarter of 2025.
Well, I think it's unlikely to occur in 2025 period, Michael, and I think that the Reserve Bank, that's what they're saying. As I said, I think that it would be bad news to get inflation quickly down to that 2.5% target range. Would only really mean a softening economy, and given that it's likely to be a stronger US economy perhaps, and we're speculating here. I'm not sure I can see that occurring, but who can tell what the future will be a year out? But at this stage, certainly the Reserve Bank guidelines are quite clear. They're quite logical, and they're telling us that there won't be an interest rate cut, or we won't get to the mid-range of the target, which is what the quarterly target, the quarterly inflation rate. We're well above that now, and we need to be there sustainably. I'm not sure even 2 quarters, is what sustainable means, but I don't think the very best would be at the end of 2025, but it may be even further out than that, and even further out in 2026. But at the end of the day, even though people sort of want to hear lower interest rates, those that have got mortgages, I think steady interest rates is good for a steady housing market.
So what is your thoughts about how this interest rate environment, the not falling, is going to affect our housing markets and buyer activity in 2025?
Well, it takes out the overarching national factor for house price growth and sentiment, doesn't it, Michael? So it's local factors, and that's incomes growth, which reflects the nature of the local economies, and local policies, policies to affect property. So, migration, of course, is another factor there. So it's all those sort of granular factors of supply and demand that will influence price growth in 2025.
And if people are confident in their jobs, which it sounds like they should be at the moment, they're just going to get on with their lives, aren't they?
Exactly. Bigger home, smaller home, sea change, green change, all those things that just occur in the cycle of life. And, if you've got steady interest rates, then you just, to pay more, you have to earn more. And our earnings are still at around about annualised 4%, Michael. So I still think that means that we're looking at around about a 3 to 4% growth, underlying growth in house prices, taking out the interest rate factor. And we know we're still way below in terms of matching supply with demand. We're recovering a little bit in terms of building new houses, but new apartments are still lagging. And it's going to be some time, maybe if ever, that we do catch up supply and demand. So as I said, going forward, I think that's what we're looking at with steady interest rates next year, is what's happening in local markets. And we know that, we'll still see stronger growth in those markets that have an affordability advantage. And that's still clearly Western Australia, South Australia, and Queensland, because their prices are still lower than Melbourne. When we look at the real measures, but catching up quickly, but still well below Sydney. So their incomes aren't lower, but their prices are lower. So they have an affordability advantage, which means they have the capacity to push prices up as long as confidence is high and economies are performing and incomes are growing, Michael, if that makes sense. So I think that we'll still see prices growth next year. And, we're just in the major capitals, but we're just really awaiting, in terms of major capital performance, of a return to confidence in the Melbourne market.
One of the other trends over the last couple of years has been the rental crisis, where there just hasn't been enough rental accommodation. And each week in our Property Insider chats, we talk about, frequently in our Property Insider chats, we talk about how we're just not building enough accommodation for our growing population. What do you see for rental trends? The rental growth has slowed a little bit as the year's finished off.
Well, of course, Michael, it had to. It was just roaring along, and it's reached affordability barriers. Tenants just can't keep paying an extra 10% a month in rents, because they just can't afford it. So, firstly, and we know that in a sense because vacancy rates are still overall remain very low, particularly for houses, and I mean very low, around about 1%, a little higher for units. But I think that's the sort of disparity between, rents stabilising, but vacancy rates remaining quite low. So there are still, fewer choices out there for prospective tenants. But I think what's happening is, given how high rents have been, that tenants are making, or prospective tenants are making, different choices. They're staying home with mum and dad longer. They're sharing, so you're getting a consolidation of prospective tenants. They're sharing with friends or siblings, relatives. They're moving out of, inner city areas to outer areas which are more affordable, outer suburban areas in capital cities are more affordable. Or they're looking at regional choices, So that's what's happened with high rents. So it's just reached that sort of affordability barrier. But we still have quite low vacancy rates for houses and units almost everywhere, but there are a few exceptions there in the unit market. And maybe that's because we're not seeing, because of the reduction in student numbers, international student numbers, the same drive into some of those markets that we would get from students. And Melbourne's one of those markets I'm particularly mentioning. But I think that, we're in for a lengthy period of undersupply in our rental markets, but thankfully we're not seeing the real crazy prices growth that we've seen, over the past couple of years, Michael.
Now, I know you're not into hotspotting, and neither am I, but are there any investment opportunities in looking at the long term where investors should consider if their budget allows them?
Well, we've spoken about Melbourne, Michael, and I think logically you look at Melbourne and say, well, it's underperformed clearly. Well, why is it underperformed? We can't look at anything clearly like we did back in the early 90s, which was an almost unprecedented economic shakedown in Melbourne. And it did take a while to recover, even though interest rates were slashed, nationally. But it is confidence, and that's a fragile sort of ephemeral type of factor, and it can take, who knows what to change confidence around in Melbourne. I know the state government's looking and is concerned about the nature of the property market, but there are some sort of ideological barriers there to sort of reinvigorating house prices. But I think it's, again, perhaps not perhaps, but it's that inner city, higher priced sections of the Melbourne market that probably needs to pick up. And, maybe the prospects from a revival in America to some degree, and this is really drawing a long bow, I guess, that may help the stock market in Australia, which may activate, some of those prestige markets. But I think the Melbourne market offers opportunity logically to start to gradually move back to where its relationship with the other capital city markets have been, particularly Sydney. And look, some of those inner suburban markets, unit markets, Michael, are offering strong yields now.
Yes.
I think that we'll see investors, which we usually see once yields start to rise, investors become attracted to that, and that pushes up prices, which then starts to consolidate the actual growth in yield. So yes, I think Melbourne logically represents good opportunities going forward, Michael, and its prices. And now, if we look at the raw medians, the Melbourne median, raw median, and we don't really look at that because that's a volatile measure, but nonetheless, the raw median in Melbourne is now below Brisbane and Adelaide. So I mean, that's
So basically, people have got to have a medium to long-term view, because I'm sure over the next 5, 6 months, those other states will still do better. But I see when interest rates eventually fall and people get more confidence, the Melbourne market will pick up. And currently you can buy things with huge intrinsic value, substantially properties, established properties, and particularly apartments, available substantially below replacement cost, Andrew.
yeah, and it's the yields that's the guide, Michael. The yields are
Yeah.
now, pushing up 5, 6, 7% in some suburbs and higher, and that's a clear sign that the return on investment, is rents are clearly have overtaken prices, and that's the value equation, Michael, which always proves to be a good leading indicator of future growth.
Now, I know you like summing the market up in one sentence in your presentations. How would you sum up 2024?
Well, it's a consolidating year following the rebound of 2023, which was predictable. We've seen the market continue to grow overall, a couple of exceptions, and it's worked its way through the interest rate ripples of the last few years, Michael. And I think we entered 2025 sort of at ground zero in a sense, without the prospect of interest rate changes, as we've discussed. But I think 2024 was a consolidating year following the rebound of 2023. And I think overall it just continues to reflect that Australian capital city housing markets by and large remain robust and reliable.
People are going to say you're always optimistic. I think, having been in the market for many, many decades now, you're actually realistic. Sure, the markets go up and down, but the long-term trend has always been up, hasn't it?
That's right, Michael, and we rely on interest rates to a large degree. But as I said, optimism, pessimism, but realism gets results, and I think that's what we've proved over years and years.
Fantastic. Well, thank you very much for those insights, and I look forward to catching up with you once a week on our regular Property Insider chats as well.
Thanks, Mike.
Before I get on with the next segment of today's show, my popular mindset message, I want to remind you that apart from this particular podcast, the Michael Yardney podcast that I publish every Tuesday and Thursday, every Wednesday, Simon Kirstenmacher and I bring out the Demographics Decoded podcast. And if you're a property investor in business, an entrepreneur, you really need to understand the trends that are going to shape our future, the demographic trends that are going to shape our future. So wherever you're listening to this podcast or watching, look out for, well, actually stop for a second, go to find Demographics Decoded and follow that as well. Now, again, before I have my mindset message with you, I'd just like to remind you that my discussion with Andrew Wilson suggested that there are going to be very different conditions in 2025 than there are this year. The property market's definitely going to continue growing, but not all properties will increase at the same level. Well, they haven't for the last couple of years, have they? And if you're like many investors at the moment, you're probably struggling. You're wondering, is it the right time? Should I buy? Should I hold? Should I sell? Should I just see when interest rates are going to fall? By the way, you're not alone. A lot of the clients we see at Metropole, they're suffering in some ways from information overload. All the news about the economy, inflation, interest rates, the housing market. Sometimes they've got too many options, not enough clarity. Boy, are you getting all these options and opinions on social media at the moment. You know what they say about opinions. They're like belly buttons. Everyone's got one, but in general, they're useless. I know a lot of investors are fearing making the wrong mistake, the wrong move. They can't afford to get it wrong. And others just don't have a clear plan. They're not really sure where they're heading. So what's the solution? Why not have a chat with one of the experienced wealth strategists at Metropole so we can put together a strategic property plan for you? You'll find that we're much more than just buyer's agents. We actually help our clients safely grow, protect, and pass on their wealth through strategic property and wealth advice. And when you've got a strategic plan, it'll help you define your goals, assess whether they're realistic, track your progress. It'll help you maximize your wealth creation, but also identify and mitigate risks. So why not go to metropole.com.au? I'll leave a link in the show notes and have a obligation-free chat with one of our wealth strategists to help make 2025 your best year ever in property.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I'm going to suggest that you should dance to your own music. Look, I got the idea for this quick chat from an interesting quote I recently read on social media. I'd like to share it with you. It said, "And those who were seen dancing were thought to be insane by those who could not hear the music." Now, to me, there's something deeply liberating about this quote. It's a reminder that you don't need to concern yourself about how others perceive your actions. If they don't hear the music that moves you, they won't understand why you're dancing in the first place. We often hold back from pursuing what we truly want because we fear judgment or misunderstanding. But the truth is, only you can hear the rhythm of your life. What inspires you? What fuels your passion? What brings you joy? It's all your own unique melody. And just because others can't hear it doesn't make it any less real. So let them watch. Let them wonder. You go ahead and dance away. In a world where everyone's trying to fit in with somebody else's rhythm, be brave enough to follow your own. Because those who matter won't think you're insane. They'll be inspired by your courage. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen-to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. Oh, and I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcast, there are 3 little buttons at the top of the player. Well, just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?